Our next presentation this afternoon is entitled Completion Risk, Why Building a Mine on Budget is So Rare. Here to tell us about the issue is Chris Haubrich. He was also one of Graham Davis's students at Colorado School of Mines, and now he's a mining analyst based in Vancouver. Chris, come on up.
Thank you. Good afternoon, everybody. As Heather mentioned, my name is Chris Haubrich, and what I'm going to present to you today is some pretty interesting data and analysis that came out of a research project that was based on completion risk and more specifically on capital cost overrun risk. I was heavily involved in this research project for a period of about 8 months last year while I was employed as an intern for Resource Capital Funds in Denver, Colorado. And I had the opportunity to join RCF through the support of a fellowship program that RCF maintains with the Colorado School of Mines, of course, while I was also working toward a master's degree in mineral economics at CSM. And although I'm no longer associated officially with the CSM fellowship program, I will be giving you this presentation today on the capital cost overrun project, unofficially on behalf of Resource Capital Funds, as RCF has been researching this topic for many years before my time and will no doubt continue researching it after my time. So in other words, the data belongs to RCF and the opinions are my own. So before I start talking about the database of projects that we built, which is really the backbone of this whole research project, I'm going to spend just a few minutes talking about capital cost overruns in general. And I'm also going to touch a little bit on the historical body of research that exists in capital cost overruns to give you some context for where this fits in. After introducing the database, I'm going to talk a little bit about the statistical analysis that we did on the database and some of the results that came from that. And following that, I'm going to wrap up with some of my own personal observations and opinions that were gleaned from about 8 months of looking at this data. And of course, I'll answer the question that I posed in the title, why building a mine on budget is so rare, as well as some other questions, but most importantly, what we can do to manage the risk of capital cost overruns today. So to start things off, a little bit about another phrase that I used in the title, and that's completion risk. And actually, from this point forward, I won't use the phrase completion risk anymore. I'm going to replace it with capital cost overrun risk, and that's mostly for simplicity. It's not too glaring of an omission, of course, because in the end, the result is the same. Whether you build a mine on time or budget or not, the end result is more capital dollars leaving than you expected. So that's a little note from here on in. Another note is anytime I mention capital cost overrun, which I promise I'll do a lot of, I'm always going to be talking about percentage overrun. So that's actual cost divided by feasibility estimated cost. Never am I going to talk about nominal or total overruns. And that's, of course, to keep the scale in play. So capital cost overruns are a very serious problem in our industry, as I'm sure many of you are aware. They have a long history, at least 50 years as far as I'm aware, and more than likely since we've been mining. It's a problem, most disturbingly, that's not very well understood, as evidenced by its long history. And so a lot of people, including RCF, have spent a considerable amount of time researching capital cost overruns and trying to get to the bottom of this problem. In fact, in the data that I had access to, outside of the database that I built, since 1965, the average industry-wide capital cost overrun has fluctuated from somewhere between 20% as a minimum industry-wide, that's a minimum, all the way up to 60% and anywhere in between. So this is a serious problem, and that's why we spent so much time at RCF trying to get to the bottom of it. So a logical place to start any analysis on capital cost overruns is to ask yourself the question, what causes capital cost overruns? And the list you see here is a selection of probably the most common reasons given by companies who experienced an overrun when they're looking back and trying to answer the question, what went wrong? The last three are particularly more common, and I would even add another one in there is the vague term general industry trends. Now, I'm not here to tell you, and this is important, I'm not here to tell you that these are not the reasons causing capital cost overruns, because I believe that they are, or at least I believe that these are the ways in which capital cost overruns manifest themselves. What I'm here to tell you is that retrospectively looking at capital cost overruns has obviously not helped at all. We still have a problem. We have for at least 50 years, as I've mentioned, and all reports suggest that we will continue having a problem. So just looking back on a project and saying this caused an overrun, this caused an overrun, this project characteristic mattered, this one didn't, it hasn't really been helpful. And I've heard lots of opinions out there as to what is the secret recipe to build a mine on time, on budget. And there seem to be, admittedly, a handful of companies, a handful of teams, a handful of people who can do this and deliver projects on time and on budget fairly consistently. And I'm, again, in here wanting in no way to discredit or invalidate those claims whatsoever. Rather, I'm here to tell you that despite that handful of teams and companies, we as an industry still very much have a problem. And so we want to build a database and really get to the root of this problem, which is exactly what we did. So at RCF, we built a database that consisted initially of over 300 mining projects, each of which was finished sometime between 2005 and 2013. It was very important to us that this data was reliable, accurate, and valid. And so in taking those 300 projects, we checked and double-checked everything and eventually came out with a set of just 50, the 50 highest quality data points that we had. We wanted this database to be rock solid so that we could base potentially very expensive decisions on the results that came out of this data. So we took it very seriously. Now, each of those 50 data points, of course, represented an individual mining project. And with each mining project, we recorded the estimated capital cost from the feasibility study, as well as the actual capital cost, as well as a whole suite of project characteristics, which you see a few of there, which we thought could be potentially important. Another note here, of course, is that this was not a data dump. We didn't Google search, mining cost data or something, at least not that simply, maybe in a roundabout way. We basically had to roll up our sleeves and build this database from scratch in order to be totally confident that the data we generated was reliable. Now, as many of you know, Resource Capital Funds makes its business investing in all types of mining projects all over the world across all different types of commodities. And so for this data set to be useful to us at RCF, we needed it to be representative of the entire sample of the industry, not of just certain projects or certain locations or certain management teams. And so this slide just shows a few different ways that the database can be split up and sliced and diced. And unfortunately, I don't have time to go through all of the ways that the data can be split and is representative. But you'll just sort of have to excuse me and take my word for it for the purposes of this presentation, that the database is fairly representative of the industry as a whole, kind of a clean cross-section. So after we built our database, we basically had what we needed to go ahead and determine which project characteristics were shown to be associated with capital cost overruns and which ones weren't. So the list you see now is a selection of the most important and interesting project characteristics which we showed in our database to have little or no correlation with capital cost overruns. And some of these may surprise you, so I encourage you to take a few moments and absorb this list and think about it. This was really the first major outcome of looking at our database and analyzing it, is a whole selection of characteristics that really didn't move the needle one way or the other. They just didn't matter enough to warrant any further research. So this slide just summarizes the previous slide in a two-column table format, which I'll return to in just a moment once I figure out the right side. Now here's where things really get interesting, and for those of you who need your afternoon coffee, snap out of it, because this is where things really pick up. Two variables that we did find to have statistically significant association with capital cost overruns were, first, one that I will call commodity market heat, which is a measure of the general direction and speed of commodity price changes at the time of construction. And the general trend here is the hotter the commodity environment that a mine was built into, the higher the average capital cost overrun industry-wide. And I'll talk more about this relationship in just a few slides. First, I want to get the second variable on the table, and that was project quality. That had a statistically significant association with capital cost overruns in our database as well. Where project quality here is, of course, measured in the economic sense, either by IRR at the feasibility study or an NPV to CapEx ratio. And the general trend here is that the more marginally economic projects with lower IRR, lower NPV to CapEx ratio, on average, had higher capital cost overruns than did their robustly economic counterparts. So here again is our two-column table summarizing all of the results. And this is a fairly simple slide that took 8 months to compile. Now that the background info and statistical analysis is out of the way, I want to focus on the really interesting part of this research, which is, what are we supposed to do about this? So first, I'd like to point out that in the commodity market heat relationship, that relationship actually held not only in the data set that we generated, which contained projects from 05 to 13, but across multiple data sets going all the way back to 1965. So this is a very strong relationship that transcends a lot of data. What I think is going on here is fairly simple, and I'm sure a lot of you have keyed into this already. Basically, as commodity prices rise and the markets heat up, more projects are planned, more projects go into queue, which ultimately drives up the competition for the inputs to build a mine, whatever that might be, which of course ends up driving up prices and resulting in capital cost overruns. Over a longer period of time, as markets remain hot, which is kind of what we saw in the last decade or so, then what we see a lot of, or what I'm sort of thinking probably drives this, is that less experienced management teams, less experienced engineers, project builders, everything enter the industry, and on net we have sort of a lower quality, lower level of experienced group building mines, which translates into more mistakes and ultimately more cost overruns. There's no real standard way to measure commodity market heat, of course, and I won't go through all the details, but basically what's important here is the prices of the commodities relative to their own recent history. And the example I always use is $1,200 gold. Today, $1,200 gold would be considered a cool market. 5 years ago, a hot market. And likewise, today, if gold hit $1,200 and stayed there, we would expect capital cost overruns to decrease. And if it had stayed at $1,200, or I guess in many ways it blew right through $1,200 5 years ago, and we got a hot market with lots of overruns. So what this is a visual that shows capital cost overruns grouped by period from 1965 to 2013. And this chart's fairly interesting all by itself. But what's more interesting is when I overlay the price of real gold during that time, real price of gold. And you can see quite clearly that the industry goes as commodity prices go, as capital cost overruns go. And sometimes I find that in analyzing these numbers, a picture really does speak 1,000 words, or in this case, probably more. So the commodity market heat correlation is, I'm not going to talk about it anymore for two main reasons. One, because like I mentioned, most people already understand it. It's not terribly groundbreaking. And two, is there's actually a built-in hedge with that relationship that protects the economics of a project. Of course, as commodity prices rise and bring with them capital cost overruns, expected project revenues should rise as fast and hopefully faster than the capital cost overruns. So on net, project economics should be maintained or improved. So this relationship, although statistically interesting, is not as important as this one that I'm going to focus the balance of the presentation on. And that, of course, is the second positive result out of our database. The most interesting result, in my opinion, the most powerful result, and quite honestly a result that I think, in talking to Professor Graham Davis, who unfortunately isn't here, this is going to be the basis of a lot of academic work going forward, and that's the relationship we found between project quality and percentage capital cost overruns. Now let me reiterate this because it's quite important. We found that marginally economic projects, on average, had higher capital cost overruns than than economically robust projects. And to my knowledge, this relationship hasn't been talked about a lot before, if at all. So when we came across it, we were naturally very skeptical. We thought, is this some sort of anomaly in the data, or is this a spurious correlation, or are we chasing down the wrong thing here? So we needed to check. We needed to be pretty comfortable with this relationship we found. And the way we did that was actually, as I mentioned, we measured project quality two totally separate ways. One with IRR and second with an NPV to CapEx ratio. And in both cases, we found statistically significant relationships to the 1% level. That's pretty rare in statistics, not only to be able to measure a variable in two separate ways, but for both of those ways to be statistically significant to the 1% level. So we were pretty comfortable going forward that this was a solid relationship worthy of more analysis. So what does this relationship between project quality and capital cost overruns mean, and why would that be? Why would those projects that can least afford an overrun on average have more overruns than anyone else? That seems unfair and cruel. Let me start answering this question by stating what I believe to be a fact. And that is that projects with marginal economics are under more pressure to optimize their plans and to reduce capital costs than robust projects are. You will very rarely see a project whose first pass economics come out at 50% IRR be sent back to the engineers with a mandate of reduce these costs, please. The same, however, cannot be said for a project whose first pass economics come out at 10% IRR. Almost all the time, that 10% project will be sent back for what's called optimization or something along those lines. And what I think is happening here is that the pressure to optimize those lower quality projects is resulting in capital cost estimates that are published in the feasibility studies that have been reduced too far on paper, which results, of course, in capital cost overruns in reality. You're essentially setting a target that is too difficult to hit. Now, what I'm about to say is probably in the 25 minutes I've got the most important thing that I'm going to say. So when people ask you later, what did Chris Haubrich talk about? This is what I want you to tell them. It's a few sentences. While most, if not all, projects could be and should be optimized prior to construction during feasibility, that's what feasibility is all about, this process must be done properly and very, very carefully. Both miners, financiers, and for that matter, everyone else involved in the mining industry should view the practice of optimizing capital costs as a high-risk endeavor. Because when capital cost optimization is done improperly, the cost-reducing efforts become little more than a paper exercise that result in a published capital cost estimate that in reality is nearly impossible to achieve, not because there's been any deliberate lying or any manipulation, but because there has been simply no room for error left in the estimate. There's no room to go wrong, and that, as we all know, very rarely happens, and so we're often seeing capital cost overruns. In my opinion, what our data set was telling us is that the more pressure a given project is under to reduce its capital cost estimate during the feasibility stage, the more likely it is to experience a capital cost overrun. As I mentioned, it seems cruel, but that's what we're getting out of our data. So this slide summarizes both findings that we made, the relationship between capital cost overruns and project quality, as well as commodity market heat during construction. And this is pretty good information for anybody interested in managing capital cost overrun risk. So of course, those projects which had marginal economics built into a hot market were at the highest risk of experiencing an overrun. And likewise, those projects built with robust economics into a cool market had the lowest risk of capital cost overrun. So why is building a mine on budget so rare? Here's what I think. Building a mine on budget is so rare because capital cost estimates do not always incorporate all of the inherent risks involved with building a mine. Now, two risks, and I stress that this is only two, not an extensive list, two risks that our database showed that are often not included in capital cost estimates because of their association with overruns are, of course, the economic climate that a mine was built into, as well as the internal process of optimizing capital costs due to pressures to reduce costs, especially for marginally economic projects. These risks are real, and they really have no hope of being managed if they're not first identified. And of course, if risks aren't identified and managed, that are associated with capital cost overruns, then you're probably going to end up with a capital cost overrun. And what I want to stress here is that the question is not whether or not these risks apply to your project. The question is whether you have identified them and managed them properly. Now, this type of dialogue lends itself to two more questions, namely, why capital cost overruns have been so consistent, and will they ever go away or self-correct? And the answer to will they ever go away is no. The reason is the same reason as why they've been around for so long, at least 50 years. That's because the pressure to advance a feasibility stage project to construction far outweigh the pressure to get the cost right, especially in hot markets and especially for marginally economic projects. Now, some people very astutely and correctly argue that the market is pretty efficient in mitigating and preventing overruns, since miners who go over their budget will not be able to raise money very easily the next time they try. There are reputations on the line when it comes to hitting budgets, and that goes for everybody, not just the miners, but the engineers and everybody. And I agree wholeheartedly, 100% with that statement. However, I would like to add that there are also reputations on the line when projects are not built at all, especially when those projects carry with them some preconceived notion that they should be economic. You see, the reality is that even in the world's largest mining companies, with the largest pipelines of projects, there still really aren't that many good projects to choose from. Certainly a lot less than infinite. So there's a pressure to make it work. And that pressure, I believe, often translates into pressure on the capital cost estimate, which, as I've shown in this data analysis, that pressure on the capital cost estimate often translates into capital cost overruns. So we've always had capital cost overruns, and we probably always will. And given the research and analysis that was done in this project, since 1965, as I mentioned, industry-wide overruns fluctuated between 20 and 60%, and that's kind of where I would peg them for mines that are under construction right now, at least between 25 and 35. So what are we supposed to do about this? Well, as I mentioned, no risk can be managed if it's not first identified, and no mine can be built on budget if not all the risks have been identified and managed. Now, I firmly believe that those projects and those groups of teams who do consistently build mines on time and on budget know something that maybe the rest of us don't, or maybe we do know that we haven't quite figured out yet. But I firmly believe that those projects which have a team including high-quality analysts, reputable engineers, reputable financiers, and I'd also add to the list in front of you, this is important, and I wish I would have included on the slide, experienced major project builders and major project managers. These are the teams and the groups that stand the best chance of identifying all of the risks. Therefore, they stand the best chance of managing all the risks. And of course, therefore, they stand the best chance of reaching commercial production on time and on budget. I'd like to thank one more time Resource Capital Funds and the Colorado School of Mines for the opportunity both to work for RCF and to present this to you today. And I'd also like to thank you for all of your attention, and of course Graham Davis and Heather Douglas for inviting me to speak to you today. With that, I'm finished and look forward to answering any of your questions.
We do have a couple of minutes for questions.
Do you have statistics on failures during mine construction or in the early years of mine operation as a result of poor practices or feasibilities that didn't turn out, including capital cost overruns?
Maybe be more specific. What do you mean by failure?
Well, when the construction of a mine isn't completed, or when the mine is closed in the early years of its mine life.
Right. So, no, I don't have those statistics, but a worthy question, because it's noteworthy that in this database I've only contained projects that did reach commercial production. So if a project was started, experienced big overruns, and never quite made it, it's not in the database. So that's a little bit of a selection bias. But if I had included those projects, the numbers would have been even more gruesome. Any more questions?
Any other questions?
Are you aware of anyone, or have you guys done it, compared our industry with other industries and see how we compare to how other people allocate their capital?
I can't say that that was part of this research. That said, of course, in this research involved reading a lot of other research, and there was a series of papers that sort of singled out the mining industry in academic literature. The mining industry seems to have the problem worse than anyone else. Another industry that has it bad is the research industry. I think maybe you can relate similarities there between the exploration and the research and the high level of risk involved, but that would be a different study altogether.
Let me maybe try and answer your question. Fred Beery from Independent Project Analysis. We've looked at a pretty careful comparison of mining sector versus other industry sectors, and I got to tell you, the mining industry continues to perform poorly relative to oil, gas, and the chemicals industry. And I think a fundamental issue really is many of the projects are less well defined and developed at the time of end of feasibility compared to their sort of peers in the oil and gas and refining sector. And so a key for improvement in the industry is really carefully developing the pre-feasibility and feasibility activities so that the project is ready to move through in terms of smooth execution. And then you can see even in hot markets, you can get a project that performs well. But if you have an ill-defined project, the basis of the cost estimate can't be that good, and then you get into a very negative spiral in terms of cost and schedule performance.
Unfortunately, I'm going to have to cut off the questions, but I think Chris is around to answer any.
I'd be happy to answer any questions outside after.